Well, the sensex and the nifty have ended in the green, and of course, for the markets overall, if you look at it, yes, we had a little bit of hurdles at the higher end. The gains were limited this week, but data shows that retail investors have definitely, picked up in terms of trade for the market, and flows have gone up as well. On this week's edition of Editors Roundtable, we'll talk about all of that and more. I have all the editors here with me. The big question that we're asking, gentlemen, of course, I have Nilesh Shah as well joining in on the show. Nilesh, thanks a lot for being with us.
Thank you.
The big question we're asking is, these all-time highs are something that, the Lal Street is up for the third straight week, but all-time highs are something that we just haven't been able to conquer.
I was starting to get the sense. Tuesday, Wednesday, we were saying all-time high, all-time high. And it never happens, right? Look at the bank nifty. It got to within 10 points of the all-time high, and then we had a 1 week of consolidation, and it reversed. So I think maybe, that is the case this time around as well. But as you said, Sonia, it's looking good. Generally it's been looking good.
I think, Prashant, we get fixated with this all-time highs, but so much action has happened in the broader markets, right? And that's been the big story this week, I guess.
Well, indeed, if you talk about the last 2 months' performance, the Nifty is up 5-6%. You'll say, hey, we've done quite well. You look at the mid-cap and the small-cap indices, they're up between 13 to 14%, telling you that the big money actually has been made in the broader markets.
And the good part is, it's been driven by retail money. So that's what, sometimes we say that, timing the market is not important, but even timing the market is important at times. I'll put my piece today, but I think retail investors are back, and I guess they are pushing the mid-cap and small-cap.
By the way, not only are retail investors back, Nimesh is also back on Editors Roundtable.
I know, I missed 2
traveling
weeks.
all over the world, right, Nimesh?
Oh, come on, not all over the world. Just 2 weeks of holidays, yeah.
And,
but good to be
Nimesh
back.
has been meeting fund managers.
And you know what?
European fund managers.
And you know what? Not that I'm back. The block deals are back. Look at this week. Some large blocks. HDFC today, Kotak Bank, we saw a large block. CMS Info. Next week, I highlighted few names. So maybe I'm expecting some large blocks next week as well. So I guess that momentum is back now in terms of deals as well.
And why not, right? At all-time high prices. Yes. If you don't monetize stock now, when will you do that?
Nilesh, welcome to the show, first of all. You think the animal spirits are back in the market?
Well, it looks like. We've come out of pretty much a long winter. The whole of 22, the start of 23 was pretty sluggish. It was challenging. Look at all the global macros that we were used to hearing in terms of the geopolitical conflict, crude oil prices, commodity prices, higher interest rates, input cost pressures, all of that put together, but it did not shake the confidence of the average investor, be it retail, be it HNI. I think they kind of pretty much kept up the confidence, and I think they seem to be pretty much well rewarded. We've come out of a great earnings season. The earnings season has honestly surprised us all. I think the RBI's action on interest rates, particularly around the last credit policy, was also surprising, positively surprising in terms of the pause, first globally to take that lead. So all in all, I think the setup continues to be pretty good. We have a couple of challenges ahead in terms of how the monsoon shapes up or what the US Fed is going to say. But I think on the whole, the setup looks pretty good.
Things look good and they are good, right? So, as they say, it doesn't have to be contrarian for the sake of it. Sometimes good is just good, plain good.
Yes.
And that's the situation right now. Fundamentals are looking pretty good, earnings and otherwise.
Yeah, absolutely. Prashant, look at it. I think interest rates seem to have peaked. Okay, unless the US Fed puts across a very discordant note and saying is, look, things are not cooling enough to the extent that they would want to, and interest rates still are headed higher. I think that would be a dilemma for most central bankers globally, that what do you do next? I think that is to me is the biggest challenge. But you leave that aside. Otherwise, if you assume interest rates have peaked, if you believe commodities have peaked, commodity prices are heading lower, and demand is pretty much resilient. It may not be the best of demand situations, but it's relatively resilient, and it's probably clawing back. So all in all, I would still expect the earnings seasons to kind of continue to be good, the outlook to be good.
Nilesh, what are you talking about in terms of earnings season? What kind of a growth are you factoring in? The near-term triggers will be the monsoon and the Fed, as you mentioned. But what about earnings growth? The fear is that mid-teens for the next couple of years, Nifty earnings growth may not come about. But the past quarters numbers are pretty okay, and input costs have cooled off. So do you think we'll get there?
I think the Nifty earnings could be a bit challenging, and that's probably reflecting also in the fact that the Nifty movement is sluggish. You've not seen the kind of upside. Because the big pockets of the Nifty, I think the large cap IT looks reasonably challenged. They themselves have guided for low to mid single digit growth.
Right.
Banks, we will have to see whether the NIMs sustain. That will be a bit of a challenge for them. But I think the real action is in the mid and the small cap companies. I think they seem to be kind of benefiting disproportionately.
Right.
They seem to have managed their cost equations well. They seem to be benefiting out of technology, this whole wave of digitization. That's basically creating new set of opportunities and perhaps giving them a level playing field to compete with the big boys. So I think on the whole, the outlook for mid to small cap earnings, I think, is way better than the headline
index.
In that context, actually, the top mid-cap gainers this week were names like Emphasis, Persistent Systems, Birlasoft. So, a lot of big movers in the broader markets as well. But Prashant, overall, I mean, of course, the market we know on Friday didn't do that great. But overall, minor gains for the week, but third straight week of an up move, right?
Oh, absolutely, Sonia. Actually, on Thursday and Friday, the pullback was nothing. 1% on the Nifty, about 1.5% odd on the Nifty Bank. So, and this is from Thursday's high. Close to close, Wednesday's close to Friday's close, it's even lesser. So it's very, very minor in that sense. On the Nifty, I mean, if you want to look at the narrow indices, the supports, etc. For the Nifty, it's about 100. At Friday's close, it's about 100 points away. The Bank Nifty is looking a little more tricky. I mean, even today on Friday, it touched the 20-day moving average, and we basically closed about 10 points above it. Now, the 20-day is important for those who are trading, looking at this in a short-term basis. The 20-day, as we've been pointing out, is the reversal kind of level. So you want the market to trade above it for both the Nifty and for the Bank Nifty as well. We were talking about numbers on mid caps and small caps, Nigel. It's for the small cap index, it's 17% from the 31st of March. And I think it is about 15% for the mid cap index. So, it's just been a feverish kind of rally in that particular space. And I would say personally, and Nilesh, I don't know, you're going to come in there, maybe a little bit of pause perhaps is not the worst idea in the world, right?
Catching your breath after a sprint.
Yeah, exactly. And so that's one. The Fed decision next week is important as well, Sonia. And I was just wondering if, so for example, before the Fed decision, we get the core CPI number, inflation number out of the US. If it does not show any big disinflation and the Fed pauses, I think people are going to be confused. Is this just that we've hiked so many times, now you want to pause? Because it'll be kind of inconsistent with what they've said and what they've projected to do. So maybe, I mean, the CPI number will be far off and then, it'll be a pause and everybody will be happy with it. But we'll see. That's only Wednesday, so as to speak. I just want to get your thoughts, Nilesh, on the mid cap and small cap. You said earnings growth, etc., is looking good. But just taking your breath, sort of, re-evaluating how much gains are already in the bag. You think that makes sense? You think we'll see a period of that?
Well, you could potentially have a situation in the market where the earnings momentum continues to be strong, but just on a momentary basis, the market goes on a risk-off mode. Pretty much what we saw over the last maybe year or even at the start of the year, that where the earnings weren't all that bad, the earnings kept pace, but for whatever reason, the stock prices did not move up. There was a huge amount of consolidation. And post this up move, it's quite possible that, based on what the US Fed says or guides, it's quite possible that we may probably have one step back, consolidate again, and then play a catch-up role post.
By the way, have earnings picked up, Nilesh? Because when I say earnings picked up, there have been lots of beats. But have we seen big upgrades to estimates? Not really, right?
Not to estimates, but the mid and the small cap space has kind of come in with a lot of surprise. So we were just talking earlier of some of the mid and small cap IT names doing well. This is despite the fact that the large cap IT have given a pretty weak kind of a guidance. And that's because the smaller companies, even in the technology space, are doing well. The smaller banks are still demonstrating better earnings growth versus the larger banks. The larger banks are growing at 15-20%, but the smaller banks are probably growing at 25-35%. And we see this kind of running across sectors. There's a huge divergence between the very obvious large cap names in a sector and the kind of earnings performance that some of the mid and the small caps are delivering in the same sector. You're seeing a huge amount of divergence. And I think the up move or the rally in the last 2 or 3 months has just been symptomatic of that. It's finally the market becoming cognizant of the delivery which a lot of small and mid caps are doing in every sector.
Okay, one thing is for sure that retail investors are back with a bang, right? And Nimesh is going to give us all of that data. Not only retail investors, Nimesh is also back with a bang. So what are you going to talk about?
So, Sonia, the whole idea is, I'm looking at the data from a retail point of view, that too in the Jan-March quarter. And that was a period when there was so much of panic, there was so much of talk about US recession. We had middle of the year, middle of that quarter, the Adani saga as well. Even then, the retail investors were net buyers in the equities, reversing the whole trend. I'll just go to the wall and explain the data as well. So, if you look at the Jan-March quarter, which is the quarter 4, the retail investor seems to be back, and that too with a bang. They've net bought equities worth $2.3 billion in quarter 4. In fact, that's a reversal of what they did in the September-December quarter. So they've sold in the previous 2 quarters, and they bought back heavily in the Jan-March quarter, that is quarter 4. Surprising to what now we are seeing the mid-cap rally, but in that quarter, the large buying has come in the large cap names. Largely, the retail investors have bought the large caps and not the mid-cap and small cap, as to what we are seeing right now in terms of rally. So what has the retail investors done in quarter 4 in terms of buying and selling? In terms of large buying, in the large cap names, the retail investors, to a surprise, has bought Adani Group stocks. That's been a big addition. Reliance has been a big addition in terms of retail participation. SBI is the other large stock where the retailers have bought, and they've also bought Ambuja 7. Again, that's part of the Adani Group as well. In terms of selling, what they've sold, again, looks like a smart selling by the retail investors. They've sold HDFC Bank, they've sold Tata Motors, they've sold ITC. It looks like they're booking profit there, and they've sold the technology stocks, which includes TCS and Tech Mahindra. So that's what the retailers have done. But look at all the 3 categories of investors in that quarter. Look at the FIs first. The FI positioning changes in the quarter 4, which is Jan-March quarter. What they've done, they've added Adani Group stocks. I think that's largely because of the GQG investment, which came in the March around March. They've also bought L&T, Tata Motors, and ITC. What they've sold in that period, the FIs have sold Reliance, which the retailer and domestics have bought. They've sold Infosys, they've sold ICICI Bank, HDFC as well. Kotak Mahindra Bank, which has been a big underperformer, they've sold Kotak Mahindra Bank as well. And they've also sold Bharti Airtel to some extent. Now look at what the DIs have done, the domestic funds have done in the same period. While the FIs have been selling Reliance, the domestic mutual funds have been loading into Reliance, they've been loading into Kotak Mahindra Bank, HDFC, Infosys, and ICICI Bank as well. What the DIs have sold in the Jan-March quarter, the Adani Group stocks, which was the whole saga which happened when GQG bought Vedanta, ITC, and DRL, the few stocks where the DIs have sold. Now look at the retail investors. I gave a broad picture, but look at some big names that the retail investors have bought in the Jan-March quarter, which is Adani Group stocks, all the Adani Group stocks, Reliance, SBI, and HDFC, a few names that the retailers have bought. At the same time, what they've sold is HDFC Bank, Tata Motors, Tech Stocks, and ITC. These are a few large names where they've moved out as well. So net, while there was so much of panic in the Jan-March quarter, that's the time when the retail investors smartly has come back into the equity markets, and they've invested $2.3 billion. So while we all say that timing is not important, but this time the retail investor seems to be timing the markets really well. And that shows up in the data as well.
All right, Nimesh, thanks a lot for that very helpful data. Nilesh, so retail investors are back, and he was mentioning a couple of the pockets that they like, right? Even in the week gone by, in the month actually, a lot of these pockets have come back in a big way, whether it's defense, whether it is autos, right? Auto ancillaries back in a big way. What do you like now?
So I still believe that the big opportunity rests around these 3 pockets, which continues to be CAPEX, the consumer. I think these 2 essentially are the other kind of strongest pockets. And on top of that, selectively, you look for things in technology or some of the new age companies. I think that kind of pocket continues to do well. The other thing, which probably another area which could pick up quite well, is the rate sensitives. And we talked about there's some increase in interest in the auto space, but auto components I think are at a very interesting juncture. Hospitality, I think that space is going to continue to kind of show a lot of momentum. Most of the hotel companies or hospitality companies still are talking of the potential for them to revise their tariffs upwards, and the demand is not kind of in any way slowing down. So that's again one big area. Real estate did really well. In the last 1 week, 10 days, we've also seen some of the home financiers do well. So on the whole, I think rate sensitives are poised to do well, even just with the pause. Now think of a scenario maybe 3 months or 6 months later, if we actually get into a rate cut mode. It's slightly premature right now to even kind of talk about it, but it's quite possible 6 months later we have a normal monsoon, the US Fed recalibrates, and we're in for rate cuts. If that happens, I think rate sensitives will do extremely well. And again, out there, home financiers, real estate guys, building material companies, I think all of them as a pack can still continue to do very well.
Nilesh, you attend a lot of conference call, especially in the mid-cap and small-cap companies. Tell us, in terms of sectors, what stood out for you, or maybe if you can just mention a couple of names which are part of your portfolio. In terms of the commentary, what stands out, and which sectors you think are to bet now from you?
So the sector, the space which I think there was maximum confidence backed with data was clearly the capital goods space.
Okay.
The cap good guys, be it railways, be it energy, be it defense, all of them have essentially a bulging order book. Okay. And there seems to be no letdown. The key takeaway there was that not only do you have a strong order book, but they were able to pass on the higher input costs and were by and large able to protect margins. Okay. That was the good news. So I think that was a sector which probably demonstrated the highest level of confidence that I would say. So that was one. The second was discretionary consumption. The top end consumption, the K-shaped recovery that we keep talking about, and India is too experiencing the same. And while mass has been a bit sluggish, but the top end, the premium segment across sectors, so be it real estate, be it alcoholic beverages, be it some of the fashion-related stuff, all of that, I think, demonstrated the maximum confidence, I think, and backed by a good quarter and I think a great outlook for the year ahead.
Sure.
Okay, let's do one thing. Let's take a short commercial break. We have lots more to talk about with Nilesh and, of course, lots of big cues to watch in the weeks to come. There's a US FOMC policy, all of that coming up. There's also something that's happening in the cement space. Nigel will, of course, tell you all about that after a very short break. Stay tuned.
Welcome back. You're tuned into the Editors Roundtable. Now, for this week itself, we had a lot of cement stocks, whether it was Ramco, Ultratech, JK Cement, or even Dalmia Bharat. All of them hit fresh 52-week highs. And the cement space on the whole was seeing renewed buying interest. So we said, let's check out and what are the top factors that contributed to this renewed interest in the cement stocks. Well, first up, remember, we're getting into an election year, and the street was factoring in a demand growth of close to around 8 to around 10% approximately. But it seems the start of this fiscal has been a little bit better. The push is expected in the second half, both from the housing as well as from the infra space. But now the street says maybe we could be surprised with low-teen to mid-teen growth. So that's for the industry on the whole. Well, the second factor is, consolidation has been talked about for the last 12 to around 18 months or so. But you've seen very limited action on ground. However, now there are hopes yet again that there could be some possible consolidation in the sector. Remember, you have a big, acquisition that was taking place out there, and the group was a question mark with regard to the debt on the books. That seems to have got sorted out, and that's why, in fact, the street again is hoping that maybe there'll be a few large players looking at buying some of these smaller companies. JK Cement, they announced very, very small acquisition of Toshali Cements. The deal was done at around $30 per ton, and it marks the entry into East India. So a small deal, but yet 150, 200 crore deal getting done, the street like that. The other one that the street is looking at is Sanghi Industries. Remember, we are aware that the debt in the books is high, the utilization levels are low, so a deal seems to be on the cards. And there were reports that indicated there were various suitors for this particular asset. On a valuation parameter, well, the stock has always been attractive, but can we see some consolidation? The street seems to think yes, maybe in the coming quarters, we'll hear some part of that. And the third factor, which is a positive for the entire industry, is the cooling off of petcoke as well as coal prices. To give you a number, petcoke prices have cooled down to around $110 per ton. That's the lowest that we've seen in the last couple of years, since January 2021. So that's good news out there. Even coal prices have seen a sharp correction. In fact, if you look at it from the end of 2022, those prices are nearly half of what it was. So coal and petcoke prices have cooled off. That's what will give a bit of a fillip in terms of, margins from year on. And a couple of brokerages, whether it's Jefferies, they're building a 200 to around 220 rupees per ton increase in the EBITDA per ton. Even Axis Capital, they're saying that the EBITDA per ton in this year will go up by close to around 25%. Finally, the big points that you need to focus on, pricing hasn't improved that much, but it seems lower input cost and higher volumes. That's what will offset any kind of weakness in terms of pricing. So cement sector, can it surprise this year? That's the big question, and earnings could be upgraded if that's the case.
All right, thanks a lot for that. And Nilesh, you want to comment on this, on the cement sector? Of course, the expectation is that, because there's so much pickup in terms of infrastructure, real estate, property prices are going up, so cement automatically would pick up. But your thoughts?
No, absolutely. I second that view. I mean, there's no denying that. The volume environment is fairly benign, especially with the kind of infrastructure pickup and the expected further pickup in construction activity. But really the big kicker is going to be the margin expansion. Yeah. And I think with crude where it is, with coking coal prices where they are, margins are set to improve. That's essentially really the big alpha for the cement sector. The point is you need to have a view on how long will these expanded margins sustain. If they sustain for extended period of time, the upside could be great. But otherwise, for me, it's actually one more commodity that you are still in a way dependent on where crude oil prices are, where coking coal prices are. It's going to be still a function of that.
Nilesh, the one big risk which people have not yet factored in or talking about much is the election early next year. We've seen in the past, just 6 months or 1 year before the elections, some sectors tend to underperform and some sectors do well. Any thoughts on which are the sectors that you would like to bet on just 1 year before the elections?
So, well, historically, a year before the elections, the consumer appliances, consumer durables as a space,
the whole rural.
Yeah. I think this year, what maybe the markets will be additionally focused on is the monsoon and the El Nino. If that plays out relatively well in terms of we have a normal monsoon or not too bad a monsoon, and with relatively stronger agricultural prices, and on top of that, a big election period coming in, then this as a sector, consumer appliances can do well. They've had challenges of demand for the last 2 years or so. Yeah. And there's been challenges of margins for the last 1 year. They have not been able to pass on the higher input prices because of a sober demand environment. If that changes, if demand gets back and they're able to kind of pass on some of those input prices, consumer appliances as a space can be in for a huge positive surprise.
Okay. Any final thoughts then before we let you go? I mean, we're running out of time, but overall for the market, anything that you want to leave us with?
No, I think it looks pretty good. I just hope that the earnings momentum that we have seen for the last couple of quarters continues for this financial year, especially with the backdrop of lower commodity prices, lower input prices, and hopefully lower interest rates. I think if all of this continues, I think finally I'm of the school of thought, it's earnings, earnings, and earnings. So if earnings materialize, I think it should be fine. The only joker in the pack, according to me, is the US Fed. Yeah. I just hope, keep fingers crossed, that they don't kind of tend to take a very different or a divergent view, which brings back a risk of kind of an environment. But otherwise, I think it still seems to be good times.
Just follow the RBI, right?
Absolutely. I think they have been very courageous and very divergent, I think, and that's great.
Okay, well, on that optimistic note, thanks a lot, Nilesh, for joining in, and thanks to all our viewers. It's a wrap on this edition of Editors Roundtable. Have a great weekend.